Hello everyone, this is Abhay Agarwal, fund manager at Piper Serica. Uh, Today is the last trading day of the month of May. So uh, I thought it is an opportune time to record our views at Piper Serica about what is going on in the global markets, Indian markets, and also talk a bit about the recent portfolio rebalance that we did and the impact of that. So the month of May has been quite an active month. The good news is that while our benchmark index Nifty is up about 1.6% this month, our fund is up about 7.5% in absolute terms. So I think the changes that we made to the model portfolio are playing out well in our favor. And we are very confident that uh, these changes will go only from strength to strength. The portfolio performance will continue to improve, and we will get back to our longer term IRR of 20% or thereabouts. So, if you look at what's happening at the global level, I think the threat of tariffs by the Trump administration have largely played out. While there is a lot of uncertainty around daily news, but now there is that confidence that if required, countries will reach out to the US to do their bilateral agreements. And some of the larger countries may come back to the table and make sure that the global trade is not affected. There will be some winners, there will be some losers. But if you look at it from the perspective of trade normalization, I think this volatility was required because there was a lot of one-sidedness in some of the trade data that we saw. So, in a way, it's good that it has played out, and now the global trade will emerge stronger from this situation. We also saw, in case of India, a very sharp worry earlier in the month when India attacked some of the bases in Pakistan. And there was a lot of worry that the situation at the border will not stay at the border, but will escalate into a full out war. Fortunately, that has not happened because I think India proved what it wanted to prove in a very significant way. And I think the global community saw what India can do. And I think that point was made. A ceasefire was announced, and both parties are sticking to that ceasefire. And we saw that in that one weekend, there are four things that happened that markets were worried about, and they all got settled just over a weekend. And from Monday onwards, the markets rallied sharply. Uh, uh, from my experience of 30 years of investing, I think this was a stark reminder for investors that you need to stay invested, you need to stay true to your allocation plan. Equity investing is not about timing the market. If you try to time the market too much, you can be sitting out of the market when the market rallies. And we saw the markets rally very sharply in 1 week. And if you were trying to time the market by sitting out of the market, trying to get lower levels for entry, you would have missed probably one of the best weeks in the year. And then the portfolio will always be behind the benchmark. So I think the savvy investors that I have seen, they are always invested. They may change their model portfolios to take advantage tactically, but I have not seen any of the investors who have been in the markets for a very long period of time and have done very well sit out in cash, because that whole assumption that you know better than the market and you can be ahead of the market, I think it's completely wrong, frivolous, arrogant, and it doesn't work. So my compliments to all the investors who stayed the course. As far as our fund is concerned, we have been holding just about 5% cash at the fund level. We have stayed fully invested. And we do not typically take cash calls in the fund only for this reasons that we don't believe that we know or anybody knows which way the markets are going to head out. So better to stay true to your allocation and your portfolio strategy. Secondly, we also do a lot of deep research. So if the stocks that you see in your model, in your portfolios, these are been bought by after a very tedious period of research where we meet the management of the company, we meet uh, all the stakeholders of the company, including its distributors, retailers, competitors, its employees, ex-employees, to get a full perspective of the company and its prospects. And then when we buy into a company, we keep on top of it through various channel checks that we continue to do. So that's the only way one can build conviction in the portfolio and continue to hold for a long period of time rather than worry about short term market volatility. So, with that big point, I would like to come back to where the Indian market is. I think the Indian market is now fairly priced at the index level, but I do not believe that Nifty as a benchmark is a very good benchmark because the index has a very lopsided high allocation to financial services stocks, and it has some stocks which has been recently added which are almost flatline earnings but have almost a $30 billion market cap. So I think that's why anybody who looks at just the Nifty valuation of 20 odd times uh, and makes an investment decision is making a mistake, because Nifty is not a good index to give a proxy for the valuations and opportunities in India. I think the real opportunity in India is in non-Nifty stocks, what we call large mid caps, small caps, because these are the companies that are growing rapidly. Some of the companies in our portfolio, like Keynes, Sirma, are guiding for a 30 to 50% annual growth. And that is where the investors need to focus. But the problem is that unless you are on ground in India, you cannot make benefit from these opportunities, because if you're outside India, you will only look at the benchmark and then say India is too expensive and I would rather not allocate. But if you're on ground, that is the only way that you can benefit from these unique opportunities where you can invest in a company that has a market cap of about $1 billion and see it go to 30, $40 billion in 7, 8 years time. And that has happened to our portfolio companies like Dixon, Apollo Hospital, CDSL, CAMS. We have multiple examples of multi-baggers. Companies that were growing very rapidly are still growing very rapidly, may look expensive on a traditional valuation metric, but when you build growth into it, these are remarkable opportunities for investors to make money. But as I said, you need to be on ground, have a very strong research presence on ground to benefit from these opportunities. And that is the reason that we have been able to add to our model portfolio a 20% allocation to small banks and NBFCs. Now, if you have been observing our model portfolio for last 2 years, we have been zero weight to lenders, to banks and NBFCs, because we saw upcoming deterioration in the lending environment, high credit costs, high loan delinquencies, over lending, and that played out. And that played out in a way that a lot of good bank stocks also got beaten down in the last quarter. But now, when the markets have kind of thrown in the towel on these banks which have good management, but they just got caught in a very bad cycle. And we think that now that cycle is turning. And that cycle is turning, and at a time when participation in these stocks is very low. So we think that this is a good opportunity for a long-term perspective to buy into some of these small banks. We have added Ujjivan Bank and Jana Bank. Both will become universal banks. I think in next 12 months' time, they should get their approval from RBI. We have added two small banks, Utkarsh and Suryoday. Again, very good franchises available at literally throwaway price right now. We have added Bandhan Bank, which is a larger bank, turning around all the hard work that they have done, is now firing on all cylinders. And the good thing is that on a valuation perspective, these banks are available at less than one time adjusted book value. So which means that there is a lot of optionality in their stock price. So little bit of outperformance over the next 3 months, 6 months, 12 months will re-rate these stocks, and we expect them to trade anywhere between 2 to 4 times their current valuation in next 2 years' time. So I think 20% of our portfolio allocation to this space is a good bet. We have made it after a lot of research, and we believe that it will play out and again help the portfolio continue to generate that alpha return. In terms of outperformance in the portfolio, we are seeing good momentum by our two agrochemical bets, Sharda Cropchem and Dhanuka Agrotech. Dhanuka is at an all-time high. I think it has almost tripled from the time we first bought it a couple of years ago. Same with Sharda. I think these are small companies, but with the global trade opening up, less pressure on chemical prices, both these companies are now firing on all cylinders. We are seeing good performance from our EMS companies, Keynes, Sirma, and Amber. All three came up with good results, better than what was the expectation from analysts, and the guidance is also very positive. So again, that's a space we are very bullish on. The other high allocation to the portfolio, as you know, has been to insurance, HDFC Life, which is at a new all-time high every day now, ICICI Pru and ICICI Lombard. We continue to believe that this is still a sunrise sector in India, where the industry is consolidated and the incumbent leaders will continue to create value. So overall, we are quite happy with the portfolio as it is. Our pharma companies are also firing. Divi's is at an all-time high. Dr. Reddy's is doing well. We are looking to add one more pharma company to the portfolio, and we have created some space for it. So we will be making that allocation, I think, in June sometime, and you will see that in your portfolio. So to summarize, I think India is back to being seen as a growth market. I think the down cycle that we saw in earnings is largely over. We're seeing a recovery in domestic consumption. We are seeing interest rates fall. I think in the next credit cycle, you will see another rate cut and probably two more after that, which will reduce the cost of capital, both for companies that want to start capex, private capex, and also for consumers who want to borrow to consume. So I think where we are quite confident that the macros are strong. Government flows are very strong. There is no pressure on the debt market. So I think if we put all these things together, India is already in a bit of a purple patch and will continue to be in that situation for next 12 months. And I think this is a time for investors to stay invested. In case you're underinvested, look at increasing your allocation to the optimal level. And we are also quite happy to see the kind of global investor queries that we are getting for our Mauritius fund. These are a lot of investors have never allocated to India, but when they scan the global markets, they find India to be a sweet spot in terms of opportunity to make money. So if the global investors are seeing opportunities, I think the domestic investors have to stay the course and benefit from it and not worry about the daily, weekly news flows or the market, sharp market moves. So with that note, I will end this podcast, and hopefully in another month or so, I'll come back to you on another update and discussion points. Thank you.